So I have the pleasure of welcoming today James Rickards, and with him it's a bit easier to say what he doesn't do than what he does do. His CV is like 5 pages long, so he's a Chief Global Strategist at the West Shore Fund. He edits the Strategic Intelligence newsletter. Of course, what most people know him best for is probably his 2 books, which were on the New York Times bestseller list, Currency Wars and The Death of Money. Recently, he's written a new book, The New Case for Gold. Is going to come out in April. And what I like about James is he's able to see and talk about trends and themes that either nobody else sees or nobody else understands, and he usually puts it very clearly. He doesn't pull any punches. So we have a couple of important themes we're going to discuss today. One is the Federal Reserve policy. Of course, we have the meeting this week. Jim is going to give us the background and also the implications of what they will do or won't do this week. Of course, we're going to talk about gold, also with reference to his book. We're going to talk about China, the International Monetary Fund, and the special drawing rights currency, or currency wars. So, James, thanks a lot for coming around.
Thanks, Fonda. Great to be with you.
So let's start with the Fed.
Yep. Well, we have a meeting this week, Federal Open Market Committee, which is the policy setting, rate setting committee of the Federal Reserve. They meet 8 times a year. This is one of the meetings, but 4 times a year they have a press conference after the meeting, so that makes it that gets a lot more attention because Chairman Yellen will come out and answer reporters' questions for about an hour or so. So you get a lot more information. Of course, my expectation and the market expectation is that they will not raise interest rates at this meeting. Now, you go back to December. December, of course, was the famous liftoff. December 2015 was the famous liftoff when the Fed actually did raise rates. But they did a lot more than that. At the time, they laid out a path for really the next 3 years. They said it was their goal to raise interest rates 300 basis points, or 3%, in 3 years, but to do it in slow steps. Not to shock the market. So that would come out to 100 basis points or 1% a year. They have 8 meetings, and so the minimum increment is 25 basis points. So I guess technically you could do 10, but that's a little bit silly. So assuming a minimum of 25 basis points, which would be consistent with the idea that they want to do things very slowly and incrementally. So you say, okay, 100 basis points a year, 25 basis point chunks, so that's 4 times a year. They meet 8 times a year, so every other meeting, and by the way, every other meeting they have a press conference. So they kind of laid out this path. Now, they did say it was data dependent and things could change, and they put in all the usual caveats. But subject to that, you would say, okay, every other meeting for the next 3 years, they're going to raise in 25 basis points. So having said that, in December, the expectation, and my expectation at the time, was that they would raise in March, subject to economic indicators. But the economic indicators are actually slightly, some of them, it depends, but some of them are slightly better now than they were in December. It looks like growth is coming a little bit stronger for the first quarter of 2016 than in the fourth quarter. Employment gains have continued to be strong. Inflation's ticking up a little bit, not to an extreme level, but certainly a level that would make the Fed more rather than less likely to raise rates. So all of the economic data looks like, based on what they said, they should raise rates in March, but they're very clearly not going to. Well, why is that? Well, we know the answer is because of the market volatility that occurred in January and February. The market went down. Stock markets went down 10%. They were very volatile. We were almost staring into the abyss in early February. And then at that point, it became clear, at least the Fed started to leak and hint that they weren't going to raise rates, and the market bounced back. So you had this, you call it a recursive function, a feedback loop, or almost like a staring contest, game of chicken, if you will, between the markets and the Fed. So what happened this time is that the markets went down so much that the Fed blinked. The Fed decided not to raise rates. They kind of chickened out of their own policy, which they laid out in December. It'll be interesting to see what they actually say on Wednesday because, again, they're not going to raise rates, but what are they going to say about it? What reason are they going to give? The data is, there is some weakness in some of the data, but based on the Fed's metrics of employment, job creation, inflation, GDP growth, et cetera, it looks like they should raise rates, but they're not going to. So all they can say is market volatility. Well, that's an invitation to the market. Every time the Fed looks like they're going to raise rates, just go down and the Fed will chicken out. I don't think that's going to happen the next time. I think in June, particularly after having skipped March, they're going to want to get back on track by June. They're going to raise rates, but the market expectation is still not better than 50% that they will. So you have this out trade where it looks like the Fed's going to raise rates in June, particularly after skipping March, but the markets are not expecting a rate increase. So there's going to have to be a convergence between those two factors. What that tells me is that we look for stocks to go down with some volatility, but kind of go down between now and June, because right now they're not fully priced for a rate hike, but I think one is coming anyway.
Okay, so that's the medium-term Fed policy. Many market observers say that was a mistake, and as you also pointed out, gold price goes up if the market perceives the central bank screwing up. Of course, it's not just the Fed, it's the BOJ, it's the ECB. They are all over the place. So gold prices have been up around 20% since December rate hike. And of course, you talk about gold in your new book. Why don't you give us a trajectory for this year and exactly this dynamic, central bank confidence versus the gold price?
We make a good point, Valentin, which is that I said that based on certain things the Fed looks at, they think the economy is strong enough to have a rate increase. But my view is that the Fed uses obsolete models. Now, again, I'm not on the FOMC, so my vote doesn't count. But my own analysis is that the economy is considerably weaker than the Fed thinks it is. I don't put as much weight on employment because employment is a lagging indicator. Yes, we are creating jobs, but it's well known that these jobs are not high-paying jobs. If you lose a $100,000 job in the oil sector and you get three $25,000 jobs as waitresses or bartenders. I mean, there's dignity in all work. I'm not knocking. I love waitresses and bartenders, so I think that's fine. But three $25,000 jobs does not replace one $100,000 job. You get three jobs. Yeah, you get some job creation, but you don't get the aggregate income. You don't get the purchasing power. You don't get the aggregate demand that we need to power the economy forward. So that's one sign of weakness, plus the fact that it's a lagging indicator. But you look at a lot of other things. Manufacturing is already in a recession. People say, oh, it's a small part of the economy. Well, it's actually a larger part if you look at the entire supply chain. A lot of that's netted out. You only count final sales or net value added in GDP, but there's the whole supply chain. The gross value of manufacturing output is much higher, so that deserves more weight. It seems to be leaking into the service sector somewhat. So imports and exports are down, world trade's down. There are a lot of reasons to think the economy is going into recession. I lean to that. So I think the Fed's committing a blunder by my analysis, raising rates in a recession, but they don't. They think they're raising rates into a growing economy, and this is just going to accelerate the recession. Now, as far as gold is concerned, I've written a few columns recently where I say gold is a chameleon, and what I mean by that is sometimes gold trades like a commodity. I mean, it is listed on the commodity exchanges, and it gets reported in the commodities report and so forth, along with steel and copper and sugar, coffee, cocoa, and all the other commodities. Sometimes gold trades as an investment. People talk about it in terms of portfolio allocation. How does the performance compare to stocks and bonds? But sometimes gold is money. I personally think of gold as money. I understand the commodities analysis and the investment analysis, but I talk about this in my new book, The New Case for Gold. And what's interesting about gold right now is that, given the fact that the Fed's raising rates, that's often bad for gold. The economy is going into recession. There's a strong deflationary vector. That's often bad for gold. And yet gold is the best performing asset class of 2016. So when I see, and the rest of the commodities complex is still near the bottom. So when I see, oil and copper and iron ore and all these commodities down here, when I see signs of deflation, when I see an economy with weakness, and yet gold is going up, which it has been, it tells me that gold is starting to trade more like money than an investment or a commodity. And that's very significant, because what it means is that it's in a horse race with other forms of money. What are the other forms of money? Well, dollars, euros, yen, yuan, but also Bitcoin, gold. These are all forms of money. If people lose confidence in the other forms of money, they'll go to gold. So again, sometimes gold rallies because it's an inflation hedge, which it is, but gold can also be a deflation hedge. But most importantly, gold is money. And when I see the dollar price of gold going up in this environment, it tells me that people are losing confidence in central banks, thinking of gold as money, saying, I want to allocate part of my portfolio not to dollars or euros or yen or yuan, but to gold.
That's a very interesting point. I've been thinking about the same topics, especially the type of money we use most is credit money.
Mm-hmm.
And now with all these crazy ideas about negative interest rates around where you actually have to pay to use credit money, then of course in your competition analogy, gold massively gains. What do you think about some of those ideas, the war on cash, the negative interest rates?
Well, it's a good question. You know, one of the criticisms of gold, and what I do in my book, The New Case for Gold, most of the book, the vast majority of the book, are reasons to have gold as part of your asset allocation. But there are some classic reasons against gold, which you hear all the time. I don't give them much weight or much credence, but I took them head on in the introduction to the book, because if you raise your hand and say, yeah, I invest in gold, or I own some gold, or I like gold as an asset class, you immediately get ridiculed. You know, they call you a gold bug or a gold nut, or worse, you know, a Neanderthal, or they say gold is a barbarous relic. So there's this whole litany of things that the gold bashers will come out and say. Well, I took them, because you hear them over and over, and I just analyzed them one by one. It turns out that every single one of them is either wrong, just objectively, empirically wrong, or the one that's right, which is gold has no yield, actually makes sense, because gold is money and money is not supposed to have a yield. So I kind of demolished the arguments against gold before I turned to the arguments in favor of gold. But just taking the one I mentioned, people say, well, gold has no yield. You know, if I buy a bond, I get interest. If I buy stocks, I get a dividend, et cetera. But gold has no yield, so why would I own gold? Well, my answer is gold has no yield because it's not supposed to have a yield. Gold is money, and money has no yield. Reach in your wallet, reach in your pocket, take out your wallet, or reach in your purse and take out your wallet and pull out a dollar bill and look at it. Does it have a yield? No, it has no yield, because it's money. Money's not supposed to have a yield. People say, oh, I can put it in the bank and get a little bit of return anyway. Well, yeah, but when you put it in the bank, it's not money anymore. It's a bank account. It's an unsecured liability of the bank. And people go, oh, well, that's money. It's just a different form of money. Really? I mean, we'll tell that to the people in Greece and Cyprus, and elsewhere, other times throughout history when the banks were closed and savers lost their money. So it's not money. It's, as I say, it's an unsecured liability of the bank, subject to bail-in rules. You say, well, we have deposit insurance. Well, you might have deposit insurance up to some level, but if you're a small business or a wealthier individual, et cetera, you might have amounts in excess of the deposit insurance limit. Oh, and by the way, you're depending on the FDIC. What if the FDIC fails? In other words, there are lots of ways that that your so-called money could turn out not to be money. And I'm not saying don't put money in the bank. I'm just saying that do it with your eyes wide open, understand what it is. And then people have money market funds, and they say, well, that's money. I can call my broker, sell my money market fund units, and have my money in the bank the next day. Well, really, there's a new SEC rule came out recently that said money market funds can suspend redemptions. They can break the buck, which means they don't have to give you $1 for every dollar you put in. They trade on stock exchanges. Well, the exchanges can be shut. There are a lot of things that can go wrong that people don't really think about. So those are not really forms of money. They can be more or less liquid, but they all have risk. Your dollar bill doesn't have any risk. It is what it is. Borrow gold or gold coin doesn't have any risk. It is what it is. And they don't have yield because they're not supposed to. Now, what's interesting about that is that you're right. We're now getting into negative interest rates on bank accounts, on bank deposits. We have them already in Switzerland, the European Central Bank, which is the Eurozone. That's most of the rest of Europe. Japan, Sweden. These are breaking out around the world, and Janet Yellen has talked about the possibility of having them in the United States, although I don't see that, at least not in the short run. Well, if gold has zero yield and bank deposits have a negative yield, gold is the high yield asset because zero is greater than negative 40 basis points. So gold actually is a high yielding asset even with zero yield because zero is more than negative.
So relatively speaking, gold wins. In the new case for gold, you put a little quote in the beginning. You quote the book of Revelations of the Bible. Talk about the New Jerusalem where the streets are paved with gold, and that sounds great. But then you also talk about things that can go wrong in the financial system, and people who know the book of Revelations also know that before we get to the New Jerusalem, things are not exactly pretty. So how do you see the way to the new golden Jerusalem to the new gold standard, or whatever you will.
Right. Well, I'll leave the biblical interpretation to the scholars. I'm more of a financial analyst and a gold analyst. But I do think that, look, clearly central banks have pulled out all the stops. They've printed trillions of dollars. They've swapped trillions of dollars. You go back to 2008, they guaranteed the money market funds. They guaranteed all the bank deposits. As I say, they printed trillions of dollars. They did everything possible. The problem is, yeah, we might have avoided something worse than what happened, something like the Great Depression, but none of that policy has been reversed. The Fed's balance sheet is still bloated. The Fed still owns all those securities that they bought with printed money. A lot of the swap lines are still in place. They haven't been able to normalize policy since 2008. So what's going to happen in the next crisis? And by the way, these crises come every 7 or 8 years. I mean, just go back to the 1987, the stock market fell 22% in one day. Not a year, not a month, but in one day, 22%. By today's Dow Jones index, that would be the equivalent of 4,000 Dow points. Now, if the stock market fell 400 points, I guarantee it would be on every evening business show, front page news, every website. Imagine if it fell 4,000 points. That's the equivalent of what happened in October 1987. Then in 1994, we had the Mexican peso crisis. And then we had a surprise interest rate hike. Orange County went bankrupt. In 1997-98, we had the Asian financial crisis, the long-term capital management collapse. And by the way, I was the general counsel of long-term capital management, LTCM, as you may know, and I negotiated that bailout. So I had a front row seat on that one. I know exactly how close global markets came to complete collapse. That we were hours away from shutting every exchange in the world. People forget about that, but that's exactly what happened. 2000, the dot-com crash. 2007, the mortgage crash. 2008, the Lehman AIG panic. So these things happen like clockwork, every 6, 7, 8, 9 years. It's been 7 years, almost 8 years since the last one. How long do you think we have before another one comes? And yet they haven't normalized policy. So what's the Fed going to do the next time? Are they going to print another $4 trillion? Legally they could, but I think they're at the outer limit of what they can do without destroying confidence, and confidence is the key to the whole thing. So what you're going to see instead is world money. You're going to see the IMF print special drawing rights. Special drawing rights, it's a geeky name, but it's a kind of world money printed by the IMF, goes by the name SDRs. They'll flood the world with trillions of SDRs. It might work because people don't really understand what SDRs are. It might just kind of blow by everybody, but at best, it would be highly inflationary. And at worst, it won't work because people will say, well, we've lost confidence in these other kinds of paper money, fiat money, why should we have any more confidence in that? And then you'll see a gold buying panic and the dollar price of gold could skyrocket. So it would be better if the leading financial and trading powers in the world sat down today in relatively calm times and did something like Bretton Woods, just reformed the international monetary system. And I think if they did, gold would play a role. I'm not saying it would be a strict gold standard, but I think gold would have some role. But I don't think that's actually going to happen. I think we're going to see a crisis first. Going back to your version of the Book of Revelations, you got to have some rough times before you get to the good times. I think we'll have a crisis first, at which point the powers will come together. They will reform the international monetary system, but they'll do so in a state of collapse and panic rather than in a calm, orderly state. In that world, people are just going to go on their own gold standard. They're not going to wait for the financial powers to create a gold standard. They're going to have a gold standard of their own. They're just going to dump paper money, get into gold to preserve wealth. It won't even be a question of, gee, will it go up or will I make gains? It won't be like buying stocks or bonds. It'll just be to preserve wealth so they'll actually have something left. So again, we talk about all this in the book, The New Case for Gold.
So that's the conclusion, probably a bottom-up revolution first, and then maybe a reform of the financial system like you have predicted a long time ago in your other books, and in fact now with the Chinese ascension to the SDR, the special drawing rights that you just mentioned, that you laid out 5-6 years ago, that path. So you have been talking about it a long time, and now talking about crisis, of course I have to ask you about China because that's a hotspot at this moment. China's
actually doing a good job of getting ready for playing both sides of the fence, if you will. In other words, yes, the Chinese yuan, their currency, also called the RMB, renminbi, has been included in this SDR that I talked about. And a lot of people think that that there are hard currencies backing the SDR. That's not true. There is a basket of currencies, but that basket is used for the sole purpose of computing the value of an SDR. So you say, what's an SDR worth in dollars or euros? Well, that's just a simple math formula, and there are 5 currencies that go into it. Now, until well, actually, technically today, there are 4 currencies. The IMF has announced that they're going to include SDRs, but that will not be effective until September 2016. So as of today, the Chinese yuan is not in the SDR, but they have announced that they're going to include it again as of September 30th, 2016. But the other 4 currencies are dollars, sterling, yen, and euros, which is what you would expect, and now they're going to include the Chinese yuan. So in that sense, China is joining the club, joining the paper money club, acting as a responsible member of the international financial system, and would not look from the outside really any different than the United States and Europe. But they're also requiring thousands of tons of gold. Now they're doing this secretly. They're doing it through stealth, using intelligence and military assets, agents in place, using banks that will buy gold but not disclose who the buyer is. Of course, it's China. China is stripping their mines. They're producing 450 tons a year internally. They're importing about 1,200 to 1,400 tons a year from Hong Kong, via Hong Kong, because Hong Kong has pretty good reporting. So we know China's getting, about 1,700 tons of gold a year. They've been doing this for 7 years. So they're up into the, well in excess of 10,000, maybe as much as 13,000 tons of gold that they've acquired in the last 7 years. Now, we don't know exactly how much of that's going to the government, how much of that is going to private consumption, because the Chinese citizens love to buy gold. They can't invest overseas, at least not very easily. The real estate bubble has popped. The stock market bubble has popped. They can't invest overseas, so they tend to buy gold. But you can make different assumptions about that. I've heard different estimates, but it does appear that officially China is up to around maybe 4,000 or 5,000 tons of gold. They report far less. The reporting is deceptive. They don't want the world to know how much they actually have. They report about 1,700 tons, but they've actually got maybe closer to 4,000 tons. But they're still trying to get to 8. They're trying to get to 8,000 tons of gold, which would match the United States. That's how much the United States has. So China is still buying gold. But here's why. Some people speculate, well, what the Chinese are going to do is launch the yuan as a global reserve currency backed by gold and run the dollar off the road. That's possible, but I don't really see that. I don't think that's what they're doing. What they are doing is hedging their position, because they have about $2 trillion in U.S. dollar-denominated assets, approximately. By the way, their hard currency reserves are going down very rapidly as well. Separate problem. They've got about $2 trillion, and they've got this pile of gold. Now, what they want is a strong dollar, actually, because if you had $2 trillion, you'd want a strong dollar, too. But they fear that the U.S. will resort to inflation to get out from under the U.S. debt burden. I think that's highly likely. The U.S. is trying to get some inflation. So what's going to happen is the real value of those dollar reserves will start to go down. Now, the nominal value, the $2 trillion number I mentioned, that'll stay the same, but it won't be worth as much. The U.S. does this all the time. We'll say to China, hey, here's the $2 trillion we owe you. Good luck buying a loaf of bread, because we're going to inflate the value. But if that happens, and you say, why don't the Chinese just dump their treasuries? They can't. The market's not that big, and the President of the United States could stop them if they tried to do it in a malicious or disruptive way. So they're kind of locked in. So they hope for a stable dollar, but if the value of the dollar asset starts to go down, the value of the gold will go up, because that's what happens in inflation. So what they've done with the paper and the gold, they've created a hedge position, and the way it will probably play out is the U.S. will get some inflation, so paper assets will go down, but the gold will go up. So that way China will preserve its wealth. My view is, hey, if it's good enough for the Chinese, it's good enough for everyday citizens. They obviously see something coming, or else they wouldn't be buying so much gold.
Well, that's a fascinating topic. I spoke to our friend Willem Middendorf recently about this, and he says that the Chinese, they acquire a lot of gold, officially, like you say, 4,000 tons, and then the rest, they store it with the people, storing gold with the people. So they're clearly pursuing the strategy, but like you mentioned, the official reserves are going down. Clearly there's a lot of, again, credit deflation going on in China. I mean, isn't that a source of volatility that is also affecting the United States and the rest of the global economy?
Sure. I mean, China is highly unstable. No, look, China's not going to disappear. It's the world's second largest economy, By some measures, it's actually the world's largest economy. By other measures, depends on how you calculate it. But over 1 billion people, world's first or second largest economy. China's not going to disappear, but they have a lot of problems. No economy goes from low income to middle income to high income without booms and busts. And this was true in the United States. I mean, we went from an agrarian economy in 1776 to a prosperous, not only industrial but high technology economy in the 21st century with astounding growth. But we had busts along the way. We had bankruptcies, we had panics, we had bank runs. We had a lot of the states defaulted on their obligations in the late 1820s, early 1830s. So China's at that stage. They've clearly got a credit bubble, as I mentioned, the real estate bubble, the stock bubble, enormous debts. I've been to China. I've been out to these ghost cities. I was with Communist Party officials at some of these ghost cities. And they were magnificent. I mean, as far as the eye can see, buildings, skyscrapers, shopping centers, apartment complexes, hotels, highway exits, train stations, airports, all empty, all completely empty. It was an enormous amount of waste. Now, it did create jobs temporarily. I mean, they were real buildings. Somebody had to roll the steel and fabricate the glass and build the buildings, and they created hundreds of thousands or millions of jobs, at least temporarily. But now these cities are all empty, so they're all going to go to ruin. So I said to the Communist Party officials, I said, well, this is all debt finance. I said, how are you going to pay the debt? He said, oh, we can't pay it. Beijing is going to have to bail us out. I said, well, that's interesting. So I guess Beijing is going to do that. But the point is, people are sort of betting against China right now financially. They're betting that they're going to have to devalue the currency, which I do expect. I don't expect it right away. They've got a couple other tricks. They can cut interest rates, cut reserve ratio requirements, use fiscal policy, basically deficit spending. So they can do a couple things to keep the game going, but ultimately, either their capital account is going to be depleted, which I don't think they'll allow to happen, or they're going to have to cut the currency, which I do expect to happen. But on the way to doing that, I mean, they don't have enough money to do both. They can defend the currency or bail out the banking system, but they don't have enough money to do both. They're going to have to bail out the banking system to some extent, and the only way to defend the currency is not to defend it, basically to cheapen it, let it devalue, so that'll reduce the hard currency outflow. So China's in a very tough position. I do expect a financial crisis. We've already seen signs of it. I expect it will get worse. Their economy will slow down. Again, they're not sinking into the Pacific Ocean, but they're in for some very rough times, and I'm more in the hard landing school than the soft landing school.
So things are going to get worse before they get better, and after they get better, we probably see a lot higher gold price. James Rickards, his new book, The New Case for Gold, coming out in April. Thanks a lot for joining us.
Thank you.